Hello, I'm Mark Apsey, Head of Indexing at Tematica Research, and welcome to the week ahead. So, as I usually do, we're going to take a look at what just happened this past week, and then what we're looking at, what we're paying attention to in the coming week. So, last week, kind of crazy, right? Started off with a longshoreman strike, and they were striking, and the union president was on tape a couple days prior with honestly what could be described as some vitriolic ranting, talking about basically how he owns this economy and wait just happens and they're going to shut him down and everything else. If you've ever seen the movie Fist, it was an older Sly Stallone movie where I think he portrayed Jimmy Hoffa. It was reminiscent to me of Stallone's character in that movie. Very kind of heavy-handed and all that kind of stuff. But I digress. Anyway, so that was Monday, Tuesday. Lots of jitters around what was going to happen in the economy. Are we back to COVID era supply chain issues? All that kind of stuff. And that persisted for a couple days. And then, yesterday we got news after markets closed, of course, that there was not a full deal, but a tentative agreement on a 6-year, I believe it's 62% rate hike. I believe the union was looking for a 70 or 72% rate hike over 5 years. Looks like there was a slight concession made there. The big issue here, of course, is automation, right? And essentially, what's happening now in the longshoremen's and warehouses workers union is honestly what we saw at the beginning of this year with the writers' strike in Hollywood, right? Lots of concerns around automation, essentially kind of machines taking jobs and those kinds of things. Now, to be clear, there is already a fair amount of automation, not in all ports, but in major ports. And clearly, the membership is concerned about what their job is going to look like in the future. Indeed, would there be a job in the future? But for now, the strike is averted. They've agreed to a roughly 3-month window, which will allow them to negotiate the balance of the deal by January 15th. Okay, so holiday shopping, etc., secured, and that is good. Of course, continued and increasing levels of attacks in the Middle East. We saw oil jump up a little bit. As you know, oil, the price of crude has been coming down pretty steadily over the last month or so. That has shifted, right? And mind you, we're not going back to seeing the high prices at the gas pumps that we saw over the summer. Where I live here in New Jersey, it is not uncommon to see a 280 handle. I've seen some places taking cash at 278. So we'll see what happens there. Of course, Friday's news was employment, right? And we had blowout numbers in employment. And generally, that was applauded. Interestingly, the one area where it wasn't, and this showed up pretty clearly in our model suite, home building and materials model, aside from the market hedge model, was the only model that was down on Friday. And when you kind of think about it, I guess it makes sense, right? Because we have blowout numbers on employment, on unemployment, and basically what does that say? It says, wow, the economy is humming, right? It's cruising along, and if the economy's cruising along, do we really need to have more cuts? And even if we do, how many and how much, right? So we saw Fed futures curve move from, I think, a roughly 66 or 68% probability of a 25 basis point hike in the next meeting, jump up to 95%, right? Pretty soon after that report was issued. So what that means, getting back to the home builders, is With rates looking like they may stay, quote, higher for longer, that means higher mortgage rates. That means people still kind of balking at buying homes because the premise was, well, they're high rates, and basically, regardless of the rates, people were bidding up and bidding up. So you would think with lower rates, those prices were supposed to come down. If it doesn't look like that's going to happen, then clearly traders are seeing a future impact on those home builders, which they decided to price in today, right? When we look at the rest of the market over this past week, generally positive. The Russell 2000 decided to shed about 0.75%. They're down about 75 bips. When you're looking at the Dow, SPX, and NASDAQ composite, Dow kind of flat up 9 bips on the week, S&P 22, and then the NASDAQ composite up 10 basis points. Looking at some other asset classes, Bitcoin and Ethereum. Bitcoin down about 5%, Ethereum down about 10%. Volatility, it was definitely higher in the week. I think it touched like a 20 handle. Friday looked like it closed just under 19 at 18.99, still a 12% gain in the week. So while we are getting some good news in the form of these strong employment numbers and possibility that perhaps there really is this softer sided landing that is coming our way. There's still a little tension in the air there, right? Vol's still higher than it has been, and certainly over longer term averages is I would say like 3 to 4, perhaps even 5 points, depending on kind of how far back you're going. Gold is hanging in there. I mean, it ticked down a little to 26.50 per ounce by Friday's close. So still in kind of nosebleed territory, not pushing new highs, but still really up there. And of course, the 10-year yield we have seen increase again as people are getting more confident in stocks. They're not so concerned, and so selling bonds, moving into stocks, right? From sectors this past week, energy topped. And that's related to the comments I made earlier about what's going on in the Middle East and speculation about potential oil disruption. Financials and utilities came second and third there. Utilities are still kind of riding a bit of a nuclear power high. They really spiked last week on the news of the Constellation Energy and Microsoft deal. They've come back a little from that. Although this week our nuclear energy and uranium model, is kind of second on the leaderboard for the week. Let's see here. Yes, up about another kind of 7.5%. Topping the list on the model side was the EV transition model, and honestly, that all has to do with EVgo. They had a killer week this week, so they are doing well. Blink charging was up pretty strongly as well, and so we're seeing some good things kind of finally out of that model. It's really, when you look at the longer term charts, it's really been kind of trending down. So it's nice to see it pick up there. I think that's about it for this past week. When we look into next week, fair bit of information, a fair bit of updates coming down the pike here. We're going to look at consumer credit on Monday. Interestingly, the number from the previous the estimates are calling for it to be cut in half. The last number we got was about 25 billion. This number is about 12, or at least the expectations are for 12. So we'll see what the final number is, and then of course everyone will act accordingly. Not a huge figure, honestly. We hear more about it in political discourse than anything these days. But Tuesday we're getting the trade balance. It's expected to tick up about $7 billion, right? And that's on a kind of a 70 to $78 billion base. So depending on your point of view, an improvement or not. Wholesale inventories Wednesday. They are calling for wholesale inventories still to rise, but not as aggressively as the previous number. So we're looking at about a 10 basis point rise there versus the 20 from the previous. And then Thursday's our big day, right? Thursday we're going to get a CPI update. We're going to get another round of employment numbers. Interestingly, when you look at CPI, that top line number still is trending lower, right? And expectations are calling for 2.3% from the previous 2.5. Core looking to stay flat at about 3.2. Now, what's interesting, of course, is that the month-over-month number is trending lower, which is good. The month-over-month is looking at a 20 basis point rise versus the previous month of 30 basis points. So, that is good. And again, just a reminder to everybody, yes, inflation has come down tremendously. However, don't forget that inflation is the measure of the rate of growth. So if something was 7% and is now 3%, it just means that it's growing more slowly, but it is still growing. Okay? So remember not to equate inflation coming down with prices coming down. It just means that the rate of the rise of prices is slowing. Still a good thing, but got to work on the other part of that equation, which is what can we, i.e., companies, government, whomever, do about actually lowering prices overall, kind of without getting into some kind of wage inflation spiral and actually causing more inflation, which unfortunately, so far the plans that everyone has seem to be pointing in that direction, right? Whether it's pumping more money into the system, whether it's introducing tariffs, these acts are inflationary, almost by definition. So it'd be interesting to see what actually happens, and of course, we'll find out a lot more after November 5th, right? Also, Thursday is unemployment. Given the blowout number that we just saw, I wouldn't be surprised if it comes under expectations, or certainly is lower than this week. So there may be folks that are being really reactionary to a number lower than what happened this week. But again, I think it's helpful sometimes to adopt kind of a Powell-esque approach to say, yes, we are data dependent, but we are not data point dependent. So, what goes up must come down, all these kinds of things, mean reversion, whatever you want to call it. The point is we had a blowout number this time. Next time, I wouldn't be surprised if it comes in a little under. And guess what? You average them together, and you're going to get, a reasonable rate. Okay. Friday is kind of the last big number here. PPI, right? Top line expected to come down about 10 bips to 1.6%. Again, on the month over month, we're also seeing a slight decrease there to 10 basis points versus 20. And then looking at the core number, actually looking like, at least on the year over year number, looking slightly higher is what the expectation is, believe it or not. 2.7 from the previous 2.4. Still, on the month-to-month, we are seeing a decrease, another 10 basis point decrease to 20 bips versus 30. Okay. I talked a little bit about some of the models here. Over this past week, again, looking at the leaderboard, EV transition model, nuclear energy and uranium, the safety and security model, holding in at the third slot there. Not surprising given what's going on, not just in the Middle East, but also in Ukraine and other parts of the world. Digital payments had a pretty good week. AI model did as well. And, kind of a mix. Models were mixed over the week. We really didn't see anybody fall out of bed. I'm just looking at our leaderboard for the entire bit of holdings. The entire group of holdings that support our 20 some odd models. And again, I talked about EVgo. Again, on the nuclear power and energy, Centrus Energy had a really good week. Blink Charging also had a good week there again with EV Trans. In terms of kind of losers, if you want to call that, luxury buying boom has had a little rough as of late, and so we've seen some of those names trade off there. I think that's about it. Again, next week's pretty busy from an economics, or at least an economic release perspective. So we will be paying attention to those. We'll also be paying attention to Fed funds futures. And quite frankly, if some of the angst on home builders ends up bleeding into other segments or sectors as well. So that's it for now. And thanks for tuning in, and we'll see you next week.